Welcome to Monday morning's special episode of Crypto Macro Insights. I'm Maya, and it's Monday, September 8th, 2025, 7 a.m. Eastern. Tom, exactly 72 hours after our Friday emergency episode covering the NFP catastrophe, we're witnessing the final act of the greatest liquidity deployment in modern Fed history. Our real-time 4chan sentiment monitoring just hit peak bearish extremes. Retail is calling for crashes while institutions quietly absorbed every Bitcoin dip below 111,000. Meanwhile, the reverse repo facility continues its historic collapse, now at just 21 billion from yesterday's 20.13 billion reading. Tom, with the Fed meeting just 9 days away and liquidity mathematics reaching their inevitable conclusion, are we about to witness the most violent sentiment flip in crypto history?
Maya, I've been monitoring the Bees board since Friday's NFP release, and the retail capitulation is now complete. Thread after thread calling for red September, predicting Bitcoin crashes to 90,000, rotating into gold because BlackRock says treasuries are dead. The irony is staggering. Retail is selling the bottom of the greatest institutional accumulation in crypto history. Friday's spike to 114,200 followed by consolidation around 111,000 isn't weakness. It's textbook institutional absorption. Every crash prediction thread on 4chan represents thousands of retail investors positioned exactly wrong at exactly the wrong time. Maya, when I see posts like Bitcoin is a joke, central banks buy gold, while reverse repos collapse and the Fed prepares emergency accommodation, I know we're at peak contrarian extremes. This sentiment will flip violently within days, but by then Bitcoin will be trading 125,000 and retail will be chasing what they refuse to buy at 110,000.
The numbers you're referencing are extraordinary. Our Fed data shows reverse repos now at 21 billion, meaning we've seen 114 billion deployed since our March baseline of 135 billion. That's 84% of the total facility liquidated in just 6 months. Tom, at this deployment rate, when do you expect complete facility exhaustion?
Maya, the mathematical inevitability is now undeniable. We've tracked this facility from 2.5 trillion at peak to 21 billion today. That's 99.2% liquidation over 18 months. But the acceleration is what matters. In March we were at 135 billion. Today we're at 21 billion. That's 114 billion deployed in 6 months, or roughly 19 billion per month. At current acceleration rates, especially with NFP catastrophe forcing emergency deployment, we're looking at complete exhaustion within 4 to 6 weeks. Maya, this isn't gradual anymore. Money managers can't sit on 4.3% reverse repo yields when they know 50-plus basis point Fed cuts are coming September 17th. The final 21 billion will deploy faster than the previous 114 billion because the urgency is exponential. I expect violent daily swings as institutions scramble to deploy, but the directional bias is absolute. We're going to zero, and Bitcoin is the primary beneficiary of this forced liquidity injection.
Beyond the reverse repo collapse, our Fed monitoring shows the entire macro environment aligning perfectly for risk asset inflation. Dollar index down 4.7% over 6 months, VIX collapsed 45%, inflation expectations rising, and now Friday's employment disaster. Tom, how do you interpret this convergence?
Maya, we're witnessing the most extraordinary confluence of monetary conditions in modern history. Dollar weakness creates demand for alternative stores of value. VIX collapse signals maximum institutional risk appetite. Rising inflation expectations make nominal assets attractive. Employment collapse forces emergency Fed accommodation. And overlay that with 320 billion in forced reverse repo deployment plus retail sentiment at maximum bearish extremes. Maya, this isn't just bullish for Bitcoin. This is the setup for the most explosive asset price inflation since the 1970s. The Fed has engineered perfect storm conditions. Maximum liquidity injection coinciding with maximum economic distress justifying maximum accommodation. Powell gets political cover for unlimited money printing while appearing to respond to crisis rather than engineer bubbles. It's monetary policy genius masquerading as emergency response. Bitcoin benefits from every single variable in this equation.
The 4chan discussions you mentioned show massive rotation into gold based on BlackRock memos and central bank buying. There's genuine belief that gold will hit 7,000 to 10,000 while Bitcoin crashes. How do you analyze this narrative split?
Maya, this is classic late-cycle thinking. Retail always gravitates towards safety exactly when the biggest risk asset opportunities emerge. Yes, gold benefits from dollar weakness and inflation expectations. It's up significantly. But gold is a $15 trillion market that moves incrementally. Bitcoin is a $2 trillion market that moves exponentially when liquidity floods in. The central banks buy gold, not Bitcoin narrative ignores that we're not trading central bank flows. We're trading forced institutional deployment of $320 billion in reverse repo liquidity. MicroStrategy, BlackRock ETFs, corporate treasuries. These aren't central banks. They're the actual flow that matters for crypto. Retail obsessing over gold at 2,700 while Bitcoin consolidates at 111,000 ahead of the biggest liquidity injection in history is peak contrarian indicator. Gold might go to 3,500, Bitcoin will go to 150,000. The opportunity cost is staggering, but retail will realize this only after Bitcoin breaks 125,000 and the narrative flips overnight.
Looking at this week's calendar, we have continuing claims Thursday and then the crucial September 17th FOMC meeting next Wednesday. Given Friday's NFP disaster, what's your probability assessment for 50 versus 75 basis point cuts?
Maya, Friday's 22,000 NFP versus 160,000 expected changed everything. The Fed can no longer pretend this is data-dependent gradualism when the data is screaming emergency. My current probabilities, 50 basis points is now 85% likely. It's the minimum credible response to avoid looking asleep at the wheel. 75 basis points is 15% likely if continuing claims spike this Thursday or if we get any additional labor market deterioration. But here's the key insight. 50 basis points is actually more bullish for Bitcoin than 75 basis points because it maintains the narrative of measured response while delivering maximum accommodation. 75 basis points would signal genuine panic, which could initially spook markets despite the long-term bullishness. Either way, Bitcoin benefits massively, but 50 basis points with dovish forward guidance is the Goldilocks scenario for crypto. It validates our liquidity thesis without triggering recession fears that could cause temporary risk-off behavior.
Last Friday, you implemented the 2% tactical add at 111,000. Given this morning's continued consolidation and the bearish sentiment extremes we're documenting, are you adjusting the framework further?
Maya, I'm maintaining the current 7% allocation, 5% core plus 2% tactical, with stops at 108,000 for thesis and validation. But I'm preparing the final 1% tactical add for the break above 115,000, which I expect within 48 to 72 hours as institutions deploy the final reverse repo liquidity ahead of next week's FOMC. The setup is now perfect. Retail at maximum bearish extremes, Bitcoin holding strong above 110,000 despite recession fears, reverse repos in final liquidation phase, and Fed forced into emergency accommodation. Maya, when retail is calling for crashes while institutions are absorbing every share below 111,000, you know the bottom is in. The final 1% add at 115,000 break gives me 8% maximum allocation positioned for what could be the most explosive crypto move in history. Risk management remains paramount. Stops protect capital, but the opportunity to capture a generational wealth transfer from retail to institutions is equally important.
The 4chan sentiment you're monitoring with people rotating to gold, predicting Bitcoin crashes, calling it red September. How reliable has this proven as a contrarian indicator historically?
Maya, the correlation is stunning. Every major Bitcoin bottom has coincided with peak bearishness. March 2020 at 3,800, May 2022 at 25,000, October 2023 at 25,000. All had identical sentiment patterns. Mass predictions of lower lows, rotation to safer assets, genuine conviction that crypto was finished. The current sentiment is actually more extreme because it's occurring during the strongest macro setup in crypto history. When retail is calling for 90,000 Bitcoin crashes while the Fed prepares emergency accommodation and reverse repos collapse, you know institutions are using retail pessimism as perfect cover for accumulation. Maya, the beautiful irony is that retail bearishness creates the exact conditions for institutional buying. No one wants to buy when everyone else is buying, but institutions love buying when retail is capitulating. This sentiment will flip violently once Bitcoin breaks 115,000, but by then the easy money will be made and retail will be chasing at much higher prices.
Tom, we're documenting what feels like a historic inflection point, the final liquidation of the biggest peacetime liquidity facility in Fed history, coinciding with peak retail bearishness and emergency economic conditions forcing maximum accommodation. Are we witnessing one of those rare generational opportunities?
Maya, September 8, 2025 will be remembered as the moment when the most extreme monetary accommodation in modern history converged with the most extreme retail pessimism in crypto history. We have $320 billion in forced institutional deployment, emergency Fed cuts incoming, Bitcoin demonstrating perfect accumulation patterns, and retail convinced we're heading for catastrophe. This isn't just a trading opportunity. It's a once-in-a-decade wealth transfer from emotional retail to disciplined institutions. The comparable moments are rare. March 2020 crisis bottom, but that was fear-driven. This is different. This is the Fed engineering maximum asset price inflation while retail remains convinced of impending doom. Maya, when historians analyze crypto's transition from speculative asset to institutional treasury reserve, they'll point to this moment as the inflection point. The next 2 to 3 weeks will be remembered as the period when everything changed, when the biggest liquidity injection in Fed history finally overwhelmed the most stubborn retail bearishness in market history.
Extraordinary analysis, Tom. To summarize this historic Monday morning for our listeners, Fortune sentiment monitoring shows peak retail bearishness with mass rotation to gold and Bitcoin crash predictions, creating perfect contrarian setup. Reverse repos continue final liquidation at $21 billion, representing $320 billion in forced deployment since March, 99.2% facility exhaustion approaching. Bitcoin consolidating strongly above 111,000 despite recession fears, confirming institutional accumulation patterns. Fed meeting 9 days away with 85% probability of 50 basis point emergency cuts after Friday's NFP catastrophe. Current position framework, 7% allocation, 5% core plus 2% tactical, with final 1% add prepared for 115,000 break targeting 125,000 to 135,000. Key insight, maximum retail pessimism coinciding with maximum liquidity injection creates generational opportunity. The next 2 to 3 weeks will be historic as the biggest peacetime liquidity deployment in Fed history overwhelms the most stubborn retail bearishness in market history. September 8, 2025, the day we documented peak contrarian extremes ahead of crypto's most explosive institutional adoption phase. Position accordingly, stay disciplined, and prepare for what may be the most violent sentiment flip in modern markets. The math is overwhelming. The setup is perfect, and the opportunity is generational.